Welcome to the FactSet podcast. I'm Jamil Sheppard from FactSet's Content Intelligence Lab, where we turn data into sharp, actionable insights that help clients navigate change and uncover opportunity. Today, we're digging into one of the most important intersections in the markets right now, the collision of the AI boom, surging data-centered power demand, and the role of private capital in building the next chapter of the energy system. Now, AI isn't just a software story, it's part of a larger shift toward a more electric economy. Data centers, EVs, and other electrification trends are together driving a step change in electricity demand. And that is putting real pressure on grids, transmission, the way capital gets deployed across the energy system. The core question is, how do we supply that demand reliably, and who's going to fund the build out? I'm joined by two people who are right in the middle of this. First, we have Olafur Oddsson Cricco, who focuses on energy systems and power market dynamics here at FactSet. And we're also joined by Mark Lewis, partner at Lime Rock New Energy, bringing a private capital lens to how this infrastructure actually gets financed and built. Olafur, Mark, thank you so much for joining us today. Let's get started.
Absolutely.
Let's do it. Great to be here.
Good stuff. All right, Olafur, let's start with you. Let's start on the demand side here. And when we talk about AI and data centers in a more electric economy, how real is the surge in electricity demand, and how quickly is it showing up in the numbers you're looking at? Because if we look at the research, there are forecasts out there talking about data center demand rising by something like 50% by the middle of the decade, well over 100% by 2030 versus where we were just a few years ago. From your vantage point, what's the right way to think about the order of magnitude here?
Yeah, that's a great question, Jamil. I guess to back out a little bit here and look at the wider perspective, we know that there is significant growth on the system right now, and has been for perhaps the last 5 to 6 years, although it's really come into focus this year and especially this summer. What we know a little less of is how much of that is actually data centers. So there's lots of projections from a bunch of different outfits on the scale of this data center boom. And some of it certainly has happened already and is coming into focus as the grid is expanding. It's harder to see how much of this is data centers themselves versus the broader economy electrifying with electric vehicles and overall load growth, as you spoke to a little earlier. So, me as a kind of as an analyst in this sector, I would say a conservative best guess would be that maybe 50% of this is data centers, 50% of this load growth. But the rest is kind of a lot harder to get a glimpse at and get really actionable data on. A few sort of numbers to put this into perspective. The two regions in the country that have seen the most growth have been those that are seeing the most interest from data center developers right now. So PJM Dominion in Virginia has seen about a little under 4% year-over-year growth since 2020, and ERCOT in Texas has seen a little under 2% growth year-over-year since 2020 as well. So those are kind of the regions to look at if I were trying to get a better sense of how large this demand is, where it's coming in, and then what its trajectory is for the future.
Interesting stuff. So potentially, from your mind, a little early in the picture to really understand where that true where the kind of the growth and the demand is really coming from there. Mark, when you hear that picture from Olafur, and when you see estimates of hyperscalers potentially spending trillions of dollars on AI and data center infrastructure over this decade, does it match what you're seeing in conversations with companies and investors, or you think the market is still underestimated this?
Yeah, I don't know that I think the market is underestimating this. I think that one of the things that we're very focused on is the market overestimating this. Depending on whose forecasts you look at and what the potential demand is, there is we think a real significant possibility that data centers could be overbuilt. One of the things that, if you look back at historical trends, what has happened, in other sort of I hesitate to call this a bubble, but a very aggressive boom. The amount of capital that's being deployed or being talked about being deployed, I think that's an important distinction right now. There's a lot of talk, and a lot of money is definitely being spent. It's showing up without a doubt. But how much of that is actually turning into real operational data centers today? And Olafur alluded to that, which is, there's certain markets where that is happening. Obviously, the greater DC area, Northern Virginia, which is the traditional location for data centers, continues to boom. ERCOT, because of the relative ease of interconnection in that market, is booming. But a lot of it you can't see because a lot of the hyperscalers are actually building power behind the meter, dedicated resources. XAI is a good example of that in their Memphis data center, which is being powered entirely inside the fence. So trying to figure out where this demand is happening and how much of it is really true data center demand versus what is broader electrification in the economy, whether that's EVs, that's reindustrialization. It's hard to pull apart right now. And the other factor that we're really focused on is what is happening around the backlash around construction of new data centers, where you're seeing certain areas, pushing back very hard with a lot of NIMBYism around data centers. So, will this continue to happen? Definitely. There's no question that build out of data centers is going to continue to accelerate. Ultimately, will all of these sort of, to the sky forecasts pan out? I'm skeptical.
Olafur, anything that Mark just kind of pointed out there on just the potential for overestimating this, and it kind of does that align with kind of what you're seeing, just being, from your standpoint, a little early to tell if it's all data center driven from the numbers you're seeing?
Yeah, that's a great question. So I think on the overestimation side, there's so many ways to come at this, but I would sort of zoom in on what Mark said with regards to sort of phantom queues and a lot of data centers that are in line to be connected to the grid that may not actually have land control or financing or backing behind them. The way that these institutions have worked in the past, where if you have a large load and you want to connect to the grid, is you've basically had to get in line. And developers have realized that your place in this line is incredibly valuable, and so they will often create, for one actual project that they want to build, they'll create 3 or 4, and just to kind of try to get ahead in line and be the first one to see that power and get that interconnection. So that is certainly one way in which there is a real danger of overestimation if you take these queue numbers for as gospel, essentially. So that's certainly one way in which there's overestimation, but there are so many dimensions of this entire supply chain. And I think, looking at it holistically, there are so many bottlenecks and so many for every part of the supply chain that is seeing this exponential growth and these really rosy forecasts, there's also another part of the supply chain that acts as a real bottleneck and can limit growth. So it's really hard to see, from our vantage point right now in 2026, how this will exactly pencil out in the future.
Interesting stuff. All right, gentlemen, let's move into the infrastructure side of things here, because I think that's kind of where we're kind of hitting on overall, or really the constraints on getting power where it needs to be. On top of what Mark just mentioned about XAI, building out their own kind of Memphis data center with really an offtake structure, that power being within their fence. Another recent case study is Chevron's 20-year deal supply to power Microsoft's AI data center campus in West Texas. I think that was projected to be around 2.7 gigawatts of dedicated capacity and no initial grid connection whatsoever. So essentially, again, it's its own islanded power system. Olafur, what does that tell you when hyperscalers are going down that route, right? Really trying to control their energy, their energy capacity and really building that out. From your vantage point, where are the biggest bottlenecks today in this infrastructure size? Is it the generation? Is it transmission, storage? Is it something else? What are you seeing?
Hmm. I think the best answer to that question, Jamil, is all of the above. So you mentioned a lot of these big deals involving data centers going behind the meter. So if you go down that route, you are going to see some potentially quite significant bottlenecks in terms of gas turbines. So the turbine that you need in order to burn gas and generate the electricity, currently, if you order one, even if you have a ton of capital behind it and you're willing to pay as much as double, for it compared to what it was selling for a few years ago, you're probably going to have to wait around 6 years, 5 to 6 years, at least at this point. So there is a lot less sort of capacity for that market to build out. A lot of these developers have actually been burned in the past with aggressive build out followed by downturns in the market that have left them with a lot of stranded assets. So a lot of these turbine manufacturers are perfectly content to kind of just sit on this bottleneck and not really expand it as aggressively as their customers might want them to. So that's one bottleneck on the behind the meter front. On the front of meter front, there are a lot of bottlenecks as well, mostly related to transmission equipment. So switchgear, transformers, and other kind of equipment that you need in order to connect to the grid, to connect to the transmission system. That is seeing a backlog right now. There's also, what we mentioned before on the institutional side of things with these long queues and these grid operators needing you to wait, a good number of years before you can really connect to the grid. So I would say that no matter what route you take, you're going to have to deal with some bottlenecks. I think, the question for a developer is which bottlenecks do you think can be overcome and can be handled, and which ones are actually going to really eat into your margins and hurt you quite significantly.
Mark, do you lean into those bottlenecks because they create opportunity, or do they show up more as a risk flag for you?
No,
I mean, when
for us,
infrastructure becomes a constraint, tell me a little bit. How does private capital look at that?
yeah, no, for us, that it's opportunity. We see all of those bottlenecks as opportunity. To give you a concrete example, we recently, earlier this year, partnered with a company called Iconic Power Systems based out of Calgary, Canada. Iconic is a substation construction firm, an EPC firm, but they also do transmission distribution construction and maintenance. And all of these constraints play exactly into the strengths of what Iconic does, and helping both the grid and expanding the grid and building substations to get more power to where it needs to be. But they also have hyperscaler clients who need substations to power these multi-gigawatt data centers. So we're looking to play that part of the market by investing in all of the various parts of the supply chain. And some of it is easier to play than others, but there's no question that there's constraints. Olafur did a great job of kind of running through all the different parts of the system and the network that are experiencing, and it's pretty much everything. Whether you're waiting 3 to 4 years for new large transformers, you're waiting for switchgear, just people and talent, the ability to build these systems. So we look at it as opportunity. And one of the things that I'm very encouraged by is the continued electrification of the economy overall. Because one of the questions we get asked a lot is, well, what happens if the data center build out isn't what everybody thinks it's going to be? We're very strong believers that the electrification of the economy broadly is a multi-decade trend that's going to continue. Data centers are not, and we're going to continue to see electrification of our economy. So we're leaning very much into that part of the investment world for us.
Great insights there. No, that's great. I appreciate that. And yeah, just seeing where these choke points can create these. I mean, we're seeing this infrastructure part of this whole kind of story really, obviously becoming a much more important one as we're talking about the more the AI boom in the data center. But gosh, you're hitting on great points around just the electrification of the economy as a whole. I mean, you guys both see this from different angles, right? I mean, are you guys aligned? I mean, do you agree on where the real choke points are right now? I mean, Olafur said, "Hey, all the above, everything." There's choke points all across the supply chain here, or how to actually bring energy to market. Or do you guys put the emphasis in slightly different places at all?
That's a good question. I think I think it's hard to get a good sense of the magnitude of the bottlenecks at this point. I would say maybe one thing that I might differ with Mark on is that at least from what I'm hearing, I think I might be a little more of an AI optimist than him. I think that data centers will likely be sort of likely a multi-decade trend. At least that's my own personal opinion. But the question is then, what do you do with these data centers? Do you kind of build an islanded grid where they don't affect the rest of the economy, or do you use them? Do you kind of harness them to drive these things that Mark is talking about, the electrification of the broader economy and bringing prices down for consumers? So that might be our largest difference. I would also just point out, if there's one bottleneck that I think is really being underestimated right now by people in sort of the capital markets world. I don't think that Mark would necessarily underestimate this, but sort of broadly by the markets in general, it's institutions themselves. So the institutions that control access to the grid, that create these market structures that allow generators to produce and sell electricity. Many of these institutions are currently reacting to a highly volatile and ever-changing environment, and I think their reactions and their action are going to be a major sort of catalyst for change in this system, one way or the other.
Yeah, look, I would very much concur with that. I think that's something that gets more broadly underestimated. Is, if you look at whether it's regulatory bodies like FERC, whether it's the ISOs, obviously PJM is going through quite a bit of turmoil currently as it tries to figure out how to deal with the enormous load growth that's taking place in PJM. But it's true across the country, and regulators at the state level are trying to figure out how do we accommodate the economic growth in our economies, whether that's general electrification or it's data centers. PJM is the most extreme example of data center growth in the country, as well as just general growth of the broader, that region of the country. But state regulators are really challenged with, how do we serve all these customers? How do we support the economic growth in our states while keeping rates affordable for consumers? And it's a real challenge. It's a genuine challenge. I would argue that we have benefited from artificially low power prices as consumers for a couple of decades. At least we've underinvested in the grid. That bill is coming due exactly at the wrong time in terms of the fact that we now have to make these major upgrades to the system to accommodate all of this additional load growth. So we've got an aging grid that needs to be modernized, that we've underinvested in for 2 or 3 decades. We've got supply chain constraints, and we've got this data center surge that's taking place. You have this really enormous confluence of things that's putting enormous price pressure on consumers and businesses. And between the ISOs and FERC and state regulators and consumer advocates, there's a lot of push and pull happening in the market right now.
And Mark, that really brings us naturally to where the money is actually going here. And if we get concrete for a minute on really where capital's flowing, when you look at your pipeline and the broader market, where is that capital flowing today in response to the current kind of AI-driven demand that we've been seeing, obviously been building up here? Because if you zoom out a bit, it feels like we've moved into this being primarily a big tech, like CapEx story, to one where infrastructure funds, real estate capital, and other private strategies are all leaning in. I guess from your seat, which parts of that ecosystem are most active right now?
All of the above. Capital's flowing everywhere right now. If you look at traditional infrastructure funds, you're seeing a very active market in PE firms and infrastructure firms buying and selling, generating, existing operating generating assets. Those trades are happening literally every day, whether that's for conventional assets, gas-fired assets, or renewable assets. Very robust. Firms like ourselves, which are focused on more on this products and services side, are deploying capital into businesses like Iconic Power Systems, or another business we invested in last year called Hawk Line Construction. You're seeing all of the companies that are a part of this ecosystem investing. You're seeing GE expanding its capacity to produce gas turbines to meet the demand. I used to be at GE Energy during the last gas turbine boom, and I know how that played out. And I suspect, GE is being cautious this time around and building out their own capacity, but there's no question the demand is there. And you're also seeing capital being deployed into earlier stage things. The incredible wave of capital that it's more on the venture side into things like fusion energy, and next generation nuclear small modular reactors, where you're seeing, billions and billions of dollars flowing into SMR plays, which, I personally think optimistically 5 to 7 years away. There's a whole supply chain topic that we could talk about around the nuclear world as well, which, we don't have time for today, but a lot of different challenges, but capital is flowing literally everywhere to try and address these challenges.
On that point right there, I mean, are there any areas that feel a bit crowded already? Any kind of that you still think any areas you feel a bit crowded, or you think there are kind of any areas that are underappreciated still, or just structurally harder to finance? I know you said all the above, but kind of anything to stick out there?
It's hard to point to anything that's not attracting capital. I think these larger macro trends are really driving capital to address it. And I think people are looking at the potential for outsized returns, because, as I mentioned earlier, this really is a multi-decade trend. This is not something that's going to go away in the next 2 or 3 years. So I think people are investing today to be in a position to take advantage of this for the next 10, 15, 20 years.
Olafur, just shifting back to you a little bit. When you look at what the grid needs and the system planning, does that capital allocation, as far as everything really needs, money's flowing in all directions per what Mark's talking about here, but does that capital allocation line up with what the power system really needs, or do you see any mismatch out there, just even kind of with the lens you have?
Yeah, that's a great question, Jamil. I would say there is a mismatch, and the best way to describe that is by saying that capital right now is very speed sensitive. So it cares about energizing these data centers as fast as possible. Now, one term that I think is really instructive here, and illustrative is something called the watt-bit spread. It was coined by Brian Janis, a former Microsoft exec. But essentially, it describes the gap between the cost of power for a data center and the value of the bits or the tokens that data center produces. And that gap right now is enormous. These data centers, at least in terms of power itself, are making a ton of revenue off of that gap. So that means two things. It means, one, that they're not going to be particularly price sensitive to the actual cost of power for that data center, because that gap is so enormous, it won't really eat into their margins all that much. It also means that for every month, every year that they are not producing tokens, they are essentially losing money, losing an enormous amount of money, actually. So that kind of structures the avenues through which capital is flowing right now. So, for instance, there has been a move towards much less efficient gas turbines, single cycle turbines, so to speak, because that supply chain is less bottlenecked. There's more sort of capacity for these data centers to buy. But that fundamentally doesn't really align well with a grid that really wants to be efficient and deploy energy resources wisely. I would say sort of one part of the supply chain that goes underinvested in an environment where capital really rewards speed quite highly is these longer term transmission investments. So a single transmission line, a high voltage one, can take between 10 and 20 years, sort of from ideation through development and into actually serving electricity. And a lot of capital right now is at least from what I can tell, is not necessarily super thrilled at investing in something like that because they think they might miss the boat. And so I would say generally, the need for speed when it comes to these data centers is kind of an operative influence on this capital, and it might leave some of these longer term investments quite underappreciated and undervalued by the market.
I'm curious too, just kind of pulling this really quick too, and I know you guys kind of come at this from different angles overall, but do you feel like what's good for investors and what's good for the grid are aligned? Anything that are there places where you'd push back on each other? I mean, I guess for example, like around how much AI labeled capital is chasing headline stories versus solving the harder infrastructure problems. Is there a good alignment there between what the investors want and what the grid actually needs?
It's a good question. I guess I'll take that. You can you can tell me whether you agree or disagree, Mark. I think that at times there can be disconnects. What's best for the grid is reliability and predictability and consistency. And so, when you have so much capital and so much interest coming in via these data centers, that can really throw things into disarray. Um, so, it's not necessarily about institutional capital fighting against the grid. I think it's more of a question of whether grid operators and these institutions such as PJM or ERCOT being able to harness this and really build a durable market mechanism atop it in a way that doesn't raise prices too much for consumers because of this data center boom, and also leads to sort of the reliability that consumers really need. And there's many ways to do that, but it really is quite a complicated problem to address given the magnitude of the growth involved here.
Yeah, I don't really disagree with that perspective at all. I think this really is the challenge. It was what I was speaking about earlier in terms of how do regulators ensure that the costs are appropriately allocated to the people benefiting from it. The fact that AI is booming and that data centers are booming in many ways, and you're increasingly seeing this, is regulators looking at this as an opportunity, not as a risk, but as an opportunity to actually manage consumer prices, where because of that watt-bit spread that Olafur spoke of, and the value of that you can actually put different rates on data centers, pay more for that power, make them pay for more of the grid upgrade that benefits the entire system and ultimately benefits consumers. So, it's not, consumers good, data centers bad. It's, this actually may be beneficial for everyone. The data centers get built, AI companies grow and prosper, and consumers benefit from a modernized grid with lower rates. I think we're going to see more and more of that discussion happening with regulators over the coming months. And it's taken a little bit of time to gel and kind of get to that point, but we're increasingly starting to see that dialogue taking place today.
That's fascinating. So I guess for our listeners who are trying to understand where this is all heading over the next couple of years, and I know that's always hard to do, get the crystal ball effect here, but there's also this question of durability, right? As far as just trying to kind of estimate what's going to happen over the next few years, whether the current AI and data center build out ultimately matches long-term demand or risks that overshooting, as I think Mark was alluding to earlier. So with that in mind, what's that one signal you're watching that tells you whether we're on track or maybe running ahead of ourselves and meeting AI related energy demand? Olafur, let's start with you. What's that signal for you?
Yeah, good question. I think that the most important one for me is the gap between announced load and actual growth in load that we can measure, that we can see on the grid. So many of these utilities around the country have accumulated a mountain of contracts, often, some really serious amount of load compared to the amount of load that they normally serve. And the ball is now in their court in terms of upgrading their systems and moving fast enough to actually service this um, on a kind of reliable timeline over the next few years. Um, so I think that is the main signal in terms of whether these bottlenecks are getting resolved or whether they are actually becoming the operative constraint on the entire system of AI, right on down from the chips through tokens. Um, so I would say that that's kind of the most important metric that I would follow. I would also add that the way I think about it, you know, the higher the constraints are, the longer the data the data center boom or the AI boom might last. Whereas if there were no constraints on the system right now, if data centers were able to get built in you know 6 months to a year and immediately go into operation, then there might be a much more dramatic drop in build out, in the next few years versus these kind of constraints, if they are real, could sort of manage the growth of this system to a more reasonable level for a longer period of time. But yeah, I'd be interested to hear your thoughts, Mark, on sort of what you're following from the capital markets perspective.
Yeah, I think I agree with everything you said, and I think the other thing that we watch closely, and that's really it's reached kind of a critical level of what are reserve margins in various ISOs around the country. Historically, you've seen 20+% reserve margins, i.e., how much generating capacity is available versus the expected peak load in any particular ISO. Those margins are razor thin today. To some question, I think I saw today actually that PJM, because of the heat here in the Northeast, could potentially run right up against zero reserve margin effectively. And there's conservation measures taking place. So, the fact that reserve margins are so tight across the country now, which historically was never the case, is something to keep a very close eye on. And I think when we start to see more of these data centers get built, if reserve margins do start to revert more to the mean, back to more like a 15 or 20% reserve margin, you can start to say, okay, maybe that CapEx boom is starting to get a little bit more shallow.
Are you guys buying each other's signals over here? It sounds like you're largely aligned, at least with how you're thinking about it, kind of a key signal over the next few years.
Yeah,
Yeah. No, I think it's a gargantuan space. There's a lot going on, but there's kind of a few physical constraints in a sense. And what Mark mentioned with reserve margins is highly instructive here, because at the end of the day, grid operators care about reliability above all else. And if they think data centers are going to cause blackouts, if they think they're going to cause prolonged issues for the grid, then they can essentially pull the plug on these projects in emergency situations. And so yeah, the reserve margin point I think is a very good one. But like I said, there are quite a few bottlenecks across this whole industry and this whole supply chain, and I think that's what makes it so exciting right now. It's both kind of hard to predict over the past few years what's going to happen, but there's also so much opportunity to work on any one of these bottlenecks and to expand them and to kind of help the system grow sustainably and reliably.
But gentlemen, this has been a great discussion because it really brings home that the AI story is as much about physical infrastructure and capital allocation as it is about algorithms and compute. We've talked about the demand shock from data centers, the ongoing electrification of our economy, bottlenecks in today's grid and transmission systems, where that private capital is actually flowing, and how investors are trying to balance reality, returns, and a long-term energy transition. Olafur, Mark, thank you both for joining and for the great insights today. And to our listeners, if you're interested in digging deeper into our AI-driven energy demand is showing up in the data and private markets, you can find more research and analysis from FactSet on these topics. Thank you for listening, and we'll see you next time.
The FactSet Insight podcast is for informational purposes only. The information contained within is not legal, tax, or investment advice. FactSet does not endorse or recommend any investments and assumes no liability for any consequence relating directly or indirectly to any action or inaction taken based on the information contained in this podcast episode. The views shared by third-party contributors do not necessarily reflect the opinion of FactSet.